Welcome to the About podcast. Here we explore your financial health in simple and easy to understand ways.
All right, well, welcome everybody to the About podcast, where we talk about everything financial planning. My name is Jeremy Scott. I'm one of the hosts here, and of course, ably and awesomely joined by Roy. Hucke as in cookie. Roy, how are we doing today?
That's right. I'm doing well, man. I feel like I haven't seen you forever.
I know, it's been a while. So, yeah, that's how it works sometimes.
Yes, sir.
We are not alone, thankfully, for this important topic we got on tap for us today. We're, of course, joined again by Julian Heron. Julian, good to see you.
Thank you. Good to be back.
Yeah, and Julian, another one of the principals at Credential Wealth Advisors, of which obviously Roy is a part. And really the reason that this whole podcast exists is a help people get better educated about their financial lives. That's why we set this thing up in the first place. And because it's something that it affects us all very, very deeply, that we all probably, who are not in the industry like myself and like you two, probably try to avoid thinking about as little as possible. Because, it's hard to feel equipped to understand like what it is, and it's got its whole language and nomenclature, and it's all very technical, but also really emotional. I get really emotional about my money a lot. I'm sure a lot of other people do. Yes. So we thought today would be good to actually cover some investing basics, like kind of take it back to the 101 a little bit, especially since we have Julian here with us. Roy has shared some of his expertise and thoughts before in previous episodes, which is great. We actually have a great one on what is financial planning. That was one of our early episodes, and I really encourage people to take a listen to that one. But on the specifically on the investing side of things, what do we need to know? What do I need to know as somebody who's, blessed to have a little bit, in savings, and I've got retirement and, those kinds of things. But wanted to cover some basics in just, investing in general, and what is the average person, what do you wish clients knew when they came in, especially maybe came into your office for the first time?
Well, and let's start and set the table a little bit because, Julian on the last episode talked a little bit about your history, but why don't you give us a little bit more about your actual journey to become a financial advisor?
Ooh, I like that.
And how you, got your, accreditation that you currently have now and
Sure.
Your credentials, I should say. And just give us a little bit of that, set the table so people know, like, why does this guy know anything here? Like, why should I listen to him?
Sure, absolutely. So I was a career switcher like many financial advisors, having run Lawan's Southern Colorado division. And I got there through being a specialist, kind of always looking to the bleeding edge technology and figuring that stuff out and seeing how it helped businesses improve their processes. And so that was kind of my way of thinking of how you engage with people for business relationships and selling and things like that. And I was a trainer and whatnot, sales manager. But I also ran the second largest beer festival in the state for many years, called the Craft Lager and Small Batch Festival. And we had been top 10 according to USA Today. We were going to have Al Roker out till the plane landed in the Hudson, in which, of course, they promptly canceled. Got Anheuser-Busch via their Michelob, to do 4 worldwide premieres at our event. We were first in the nation to do all lagers, first to introduce small batch distilled spirits, first to do craft cocktails, nice. Or beer cocktails rather, first to be all solar powered, all these different things. So it had really grown. And we decided we were going to build an event center. Because in our town, Colorado Springs, there really isn't a good place. An old, big, huge venue, an extremely old, dilapidated, small venue. And so I started to work on that and stopped working for Lawan to work on that and raise money. And a friend of mine who ran a pension was like, I don't understand how you cannot work. I was like, what do you mean? It's just planning. And he was the CFP, ironically, but had always been in the pension world, so he never really applied it.
Oh, okay.
It was all theory to him because he was pension world. And he's like, I don't think I could make it 3 weeks. And I was like, well, to me, it's just planning. That's all you got to do. And so he started to browbeat me that I needed to become a financial advisor once that whole project was done. And I had grown up across the street from the number 2 at Edward Jones and next door neighbors with the number 2 at A.G. Edwards. And so as a child listening...
Not small names in this particular world.
Yeah, exactly. And so as a child listening to them talk, I thought, gosh, what a boring industry, and what a soul-crushing one, because I heard them constantly talk about the regulations and all the constraints and everything else. And so I knew I'd never do that. So when he started browbeating me, I was like, Howard, there's just no possible way. But since I did know a lot of people in the industry, I called a few, and I said, this friend of mine says I have to do it, and I just can't imagine it because I'm too entrepreneurial. And at the time, the head of Edward Jones's research, who was a family friend, said, well, this can be very entrepreneurial, but definitely don't take it if you're thinking it's a job. It's not worth it. And a different friend who helped open up, parent of a friend who had opened up the Stiefel Nicholas first branch when they started, said, look, this is the hardest job in the world to make $50,000 and the easiest to make $500,000. But the time in between is a lot of pain and suffering and a lot of time. So he kind of reinforced that narrative, which made me, of course, look into it a lot more and decide, okay, there's a lot of regulations, but you can be creative. I mean, look at all the times Wall Street gets in trouble because they're sometimes trying to be creative. Sometimes it's just crooks, but
right.
There is that flexibility, and finance really does innovate a lot of things in our nation. So
absolutely.
So it's it really could fit me. So I get to Edward Jones, used to being the specialist that people come to me for help, and so to get heading in that direction, I ask lots of, well, why this, why that, and never got any answers. The closest I got once was in an early training, and somebody from our stock department came out and said, do you want to be a stock jockey, pushing stocks and da-da-da-da-da, essentially making fun of it to try and say, this is not what we do. Even though before hiring, it sure sounded like it from all of the stuff. It's like, we're going to be a trader and this and that. And that's, of course, not really the job of a financial advisor. And so then as I went in and called my contacts, it was like, well, that's why we let the vendors do the training. Well, the vendors, of course, are conflicted. They want to sell their product.
Right.
And so they would be the worst person, in my opinion, to have you do the investment training. But nobody could know. So I said, okay, well, I'll do what I did in other industries. I will figure this out. I'll go get some designation somewhere. Stumbled across the CFA, which I learned was considered to be one of the hardest in our industry and one of the highest marks.
And CFA is
Chartered Financial Analyst. Thank you. From the CFA Institute. And so basically that is master's level coursework, some PhD. It's 3 tests over as short as 18 months if you can study full time, or usually closer to 3 years to do.
Wow.
So 1 in 5 who start finish because it's just too much work. I mean, the month or two before the test, if you're not studying essentially full time, you're probably not passing.
Oh, wow.
And because to give you an idea, and these are very rough numbers, but you're in any given test, you're reading from 4,800 pages in the first test down to maybe it's 3,600 in the last. You've got somewhere in the neighborhood of 600 learning objectives and about 12 pages of mathematical formulas to memorize and expound and know and things like that for each test.
So I really appreciate you dumbing it down for this podcast today for those of us who are just really need the basics, because that all sounded really scary. And you're talking about somebody who went to seminary and read a lot. So
yeah. It's the only time I've ever actually had my brain hurt, physically ache. It's the weirdest feeling.
So I can definitely see why we're talking to you.
Sure.
And of course, not to discount Roy, who's I'm sure.
Hey, I'm the planner, man. This is why Julian and I are good partners.
Right,
because
exactly.
I'm the planner. He's not a planner.
Yeah.
Right.
Yeah, I mean, he can tell you all kinds of things in the same vein on trusts that I'm like, they're trusts. And he's like, no. It's this trust and that trust and this one and that. You know. So.
Well, we'll have a role to play. My
That's
role
right.
is I'm here to play the dumb guy. All right. So to start us off, like, what is? I mean, again, we've talked about this again. Plug for the What is Financial Planning episode. That is more than just I have a 401k. Even though that's where most of us who are kind of lay in this world will encounter investing in any kind of like formalized form. It's usually going to be through retirement. And however we're hopefully providing for ourselves and our loved ones in retirement, whether it's 401ks or IRAs, and usually employer-based stuff and all that. But it's more than that. I mean, investing can be, more than that. So maybe set the table a little bit. Like, when you think about investing, what does that encompassing be, especially beyond just what we would typically think of when it comes to retirement?
Sure. So when I think about that for the individual, I think the first thing I think about or word of encouragement I'd give is that in part our industry uses lots of acronyms to scare people because there's an old saying in sales, where there's mystery, there's margin. And so if it sounds very technical, then you can never understand it.
Right.
Thus you must pay us. And that is not the case. Kind of like we just said with the CFA, what it takes is lots of studying.
Right.
So a lot of people choose to outsource it because they don't want to put that kind of time in. It's just not interesting to them. And I think that the starting point is just that, to decide what am I committing time-wise to, given that, where can I have some sort of edge or view? And if I can't, because I'm putting in very minimal time, then investing according to that as well. Because you have to know your starting point and your timing point. So that's why, in a large part, for many people, indexing has become such a phenomenon. Because if I really want to invest very little time, I will have no view, excuse me, that I'm going to apply that might give me some sort of edge. And so I just want to get the market's return. And so I buy the index.
Right.
Because at least I'm not less than or more than that return.
Yeah. And that'd be by buying the index. You're talking about investing through things like mutual funds and
and
that
ETFs,
kind of stuff. And ETFs.
Like buying the S&P or buying the all country world index, or if index has the total stock market, or there's a million of them. But the idea is I have no view to express. And so I just want the return of the cumulative total. And I want to take as least risk to get that return by way of diversifying to everything. Right. So you don't have the risk of an individual company doing something. You have the risk that is systematic wide that you can never get rid of anyway.
Yeah. So if I'm understanding correctly, I think view to expression means I don't have any particular knowledge or insight about any particular industry or any particular company that makes it interesting to me. Like I was a former software engineer, so I know something about, that kind of world and the companies within that kind of world and all that kind of stuff. And I may think, I think this particular firm is doing something interesting, so I might want to individually invest in that. But I'm basing that on my own personal, view into that space and whatever it is that I might know, or don't know about that space. But for most people, probably don't have a lot of, deep knowledge into maybe outside of the industry that they work in. Mm-hmm. So that's where the indexes come in, and you're just like, okay, I'm going to outsource that and just say, I'm not going to take the huge risk of saying I'm going to put all my eggs in this one little basket.
Right.
Yeah.
Right. Exactly. And that kind of aligns with things they've been told their whole life of diversify and things. And,
So example then would be for people who just don't know much about investing. If they could buy some Pepsi stock and just own that, but they're going to live and die by Pepsi, versus an index that you're referencing, like the S&P 500 is an example of one that's kind of popular. 500 companies, and they could put $100 into Pepsi, or they could put $100 into a position that has 500 positions, so they're not living and dying by one company.
That's right. And so this trade-off there is maybe Pepsi does better than the 500 collectively, but you don't have the risk of Pepsi being Enron.
Right.
Yeah.
And it doesn't matter how big. I mean, MCI WorldCom was very, very big.
Very big.
And you just never know.
Yeah. I mean, I think that's just sort of the effect of averaging, right? I mean, anytime you're averaging things, you're kind of chopping off the peaks and filling in the valleys, and and then hoping the general trajectory continues to be up, which the stock market on the long term has always been, right?
And always will be unless we go in decline.
Yeah.
If the stock market isn't a long-term decline trend, then so are we as a country.
Yeah. True. So before we actually hit the record button, you made me take a quiz.
Yeah.
So the FINRA financial literacy quiz, which was 7 questions. So what brought that to mind as something?
So when I'm thinking of brand new investors,
and we'll link to that in the description, by the way, for those who want to do it. Anybody can do it. You can go online and take it.
And I recommend everybody do it. In a sense, I think the more data they get, maybe that helps push for financial literacy in schools. But it's a great way just to see what do you know, because we don't train it in school. So there's questions there about compounded returns, which is something we would call in Nerdland the time value of money, and interest rates and the difference of a mutual fund versus a stock, and mortgages, and all the ways finance affects your life is that quiz. So I always think it's a great place to start. You can do it by yourself, and or show your results to the financial advisor. You can compare yourself to the country, to your state, and see how you did, which you did excellent.
Well, I want to say, what was your score out of 7, Jeremy?
Yeah, it was a 7 out of 7. I wasn't going to say anything. But
I want to just, why do you think it was a 7, Jeremy?
I think it's because I hang out with you, Roy. And I do this podcast. Like, you don't have to be a host of podcasts. I think if you just listen to this podcast throughout,
you would be in the know.
You'd be at least a 5 or 6 out of 7 on that one. I gotta say.
And then the interesting thing was, Julian did say to look at the national average was a 3.2 out of 7, but Colorado hugely improved at 3.3.
3.3
out of 7.
Slightly better than average.
So not even a 50% pass rate on Colorado as a whole, which is not good, or the nation as a whole. So we do have a real need for financial literacy and improvement, and that's part of the decision behind this podcast, is to help with that. So carry on, Julian.
So I recommend everybody do that, because if you are the national average, don't feel bad about that. You're the national average, but that's going to make investing feel even more complicated. And so then take the time to see what you missed and learn a little bit about it. So which was, of those questions, which was the most interesting one to you?
I didn't think about this. Let's see. I think the ones, anytime you're dealing with interest, is interesting, because I think in your daily financial life, that's one of those places that probably you're impacted, that I feel impacted pretty dramatically on a regular basis, because we encounter it in so many ways. I just purchased a home, and great time to buy a home from a price perspective. Horrible time to buy a home when it comes to interest rate. And I'm already looking like, oh, I got to refinance it. So we, just life conspired that's when we had to do it. But I think those are more interesting questions to me, because I think between mortgage rate interest and credit card interest, but then also savings interest, which is swung dramatically in the last couple of years.
Yes.
The magic of compound interest giveth and taketh away. When it's compounding your assets, that's great. When it's compounding what you owe, it's not so great.
Yeah.
So I thought those questions were really interesting too, because thought I had a pretty good grasp on it, but I really had to think. And a couple of them, you're like, okay, like how long would that take?
Right. And our experience with interest. And I used to teach people to launch their businesses, and we took them through a financial literacy piece and discussed time value of money. And for the audience, what that really is saying, it's similar to how you've learned compounded interest, if you have, but essentially 2 values of money can be equal through time given an interest rate. And so you can, I'm just going to make up these numbers. They won't equate mathematically, but let's say you have 5,000 and 10,000, and the time between is, 5 years. You can see that they're equal through time, through compounded interest of, say, an interest rate of, you might be able to do that faster in your head, but what would that be? That'd be something like 12, right?
I actually didn't hear all the scenarios.
5
I was thinking about
10.
the next thing I'm going to say.
100% return. Anyway, I think it's around 12, I think. But they're equal through time through that interest. And so when you look at it that way, that $5,000 in the beginning could be the money you receive for a loan and what you'll pay back at that interest rate. Or it could be the money that you save versus the money you will have after the return.
Right.
And so they're equal through time through that. And what I've noticed, for instance, is when a company will offer you 0% financing, most people won't take it because they know behaviorally they'll forget to pay on time or something, and then all the interest accrues, and then they end up paying way too much. Whereas when I've used that, even when the rates were terrible, I'd just go buy a CD with the money I would have paid for cash and have it come due a month early, because that company just gave me their money for free. And I went and earned interest on it, and it made my purchase cheaper to me.
So you're saying if you were to say buy something for, $1,000 and you're like, okay, we'll give you that instead of just writing a check for the $1,000.
Yep.
You'd say, no, I'll take your 0% financing and I'll take my $1,000 and
buy a CD. But I only have to maybe buy the CD with $800.
Yeah.
And then it becomes $1,000.
Right.
And so the purchase was $200 cheaper. It comes due in advance, so I never miss the timing for them. Mm-hmm. And it's the people that do that basically allow the companies to give it to you for free.
Right.
So people won't do that out of fear, like you were saying, because interest rates are stress to us always.
Yeah.
As well as corporate programs and things, and it's used against us. But that is a form of investing, just as much as Dave Ramsey talking about paying off your debt. Well, if you're in credit card debt, getting 22% against you, you don't invest in that because you're not guaranteed to earn 22%. Right. But if you're paying it off, you are guaranteed to not pay it.
Right.
Yeah.
And so it's a good return. That's a good investment.
Debt is a big area. So there's the debt side and there's the saving side, but debt is a big area where I can tell people I can make you 22% right now.
Right.
Just
now
pay
today.
off this credit card that you're paying 22% on, right?
Right.
Yeah.
So that's one real area. And the piece I was actually thinking about as you were talking, sorry about that, was the rule of 72, which is something we've talked about before, I think, on this podcast, maybe not. But so that's on the savings side of your life. And the rule of 72 states that take your interest rate of return and divide it into 72, and that's how long it takes your money to double. So
72 into it.
That's what I said. Your interest rate into 72. Is that what I said? So divide it into 72.
Right.
And so make it an easy. If you had a 7.2% rate of return that's being offered you on your savings account at the bank, how long would it take your money to double?
10 years.
10 years.
Boom.
Yeah.
So if that was 1%, how long would it take your money to double?
A lot longer.
72 years.
72 years. Divide by one is one.
Divide by one.
Yeah,
72 divided by one.
Yeah.
So 72 years. So you can kind of see the difference. Well, that doesn't seem like a big difference from 7 to 1, but time-wise, it's a huge difference, right?
Yeah.
So, but knowing little
Yeah.
things like that are really important to like, okay, should I, I talk to a lot of people right now about, hey, your interest on your mortgage is 2.5%, right? But if you're getting let's say 5% at the bank on cash,
right?
Should I keep the cash or pay more on my mortgage in advance?
Yeah, see, this is where it gets interesting, especially now when you've got it. I don't feel like before we had a lot of times where we had that level of dichotomy where you had a 2.5% mortgage and you're getting 4% on your money market.
Yep.
You're just like, oh, maybe I don't pay principal down.
We had the inverse from the 80s going backwards as bond rates went down.
Yeah. It used to be the other way around, like always, because the assumption was always that your debt percent, your interest rate on your debt was higher than your savings rate, and we're in this weird moment in history that eventually probably correct itself.
It will.
But where people have the other scenario, and so the standard advice of always pay your debts down is like, well, maybe that's not the right advice.
Well,
now you use one of those terms we use to scare people, so you have to pay us. Saying, let's do interest rate arbitrage, which is exactly what Roy is talking about. So I can risk free because it's a money market, a bank CD, whatever. That's quote unquote risk free because of our
That's
regulations.
a financial term, right?
Yeah.
Risk free rate of return.
Yeah. So typically in finance, the only thing we can call risk free is a treasury bill. But let's use that. So you can buy a treasury bill today and earn more interest, and it's fully backed up by the full faith and power of the U.S. government. So that's why it's quote unquote risk free. And you will earn more interest than on your mortgage. So clearly you should do that. The question is, if you wanted to nitpick, will you earn more than your mortgage and inflation? Ideally you want to earn more than both of those combined.
Right.
And then you truly won at that, because your debt is getting cheaper because of inflation as the value of the dollar shrinks. Your return is higher and it's fixed higher. So your money is growing and growing.
Yep. But if your starting place is a 2.5% mortgage, I mean, hopefully we're, back into the era of somewhat sane, inflation rates, but you had 2 or 3% on top of that. I mean,
interesting is because what you said was it's opposite. So when I try to convince a client like, hey, you can actually make money by not paying the additional payment on your mortgage right now, pay that just the minimum required, and keep the difference because you're making a spread on those dollars. And it's very hard for clients to accept because they're not used to doing that. They've been conditioned. Right. They're like, I need to pay my mortgage though. I need to pay it down faster. And you're like, well, your debt's really cheap and you're actually making more money by not.
Right.
But it's hard for them to accept that. So some people still have to pay it off.
And that's why one of the things, and this is for a different podcast someday, but one of the things we would look at is clients' financial condition, because if you're not paying it off, you are substantially more liquid, and therefore you can handle risk a lot better than somebody who has been paying down their mortgage but doesn't have any cash in case something happens.
Right.
All their liquidity is in their property, which they can't they can't get to quickly.
Yeah. And I do think that
without paying the higher mortgage,
without paying a higher rate.
And there is a somewhat built-in assumption here, though, that also in lieu of that extra principal payment to my mortgage, I'm going to, put extra into, like a money market or, something that's got that fairly risk low or riskless, whatever, return. But then at the end of the day, maybe when, the rates go back, back over, I'm not going to take that money market and buy a boat. I mean, I suppose I could. Yeah. There's nothing stopping me from doing it. But the idea then being, okay, but then I'm going to take that and then make a lump sum payment towards my mortgage or some other high interest debt or, something when it goes back the other way. So there's a little discipline involved that I have to have, and I have to be disciplined in the future to use what I've saved in the right way, versus, once I've paid that extra towards principal, that money's gone, right? And so there's a human nature element, I think, to it too, where you're just like, okay, financially it all works out, the numbers all work out, and I have to be in the headspace to go when I see that account balance with that big number in it, I should not be thinking, sports car. I need to be thinking, someday I'm going to use that. I'm going to make a lump sum payment towards the home mortgage or whatever it is that I'm not doing right now. So there's a little bit of self-control, and that's why I think, as always, and we plug, working with financial planners is, you can't tell me not to do something as my financial planner, but you can remind me of my goals. Yep. So I can come to you and say, no, I'm really buying the boat, and Roy will go, okay, buy the boat.
Right.
But you
We're
will
retire 3 years later. You okay
right,
with that?
and you will remind me, like, yes, but remember this was your goal and this is what you're trading, and then I will go, okay, but I really want the boat. You're like, okay,
that's fine.
That's fine.
Trade-offs, right?
Less, right?
Yep.
Yeah.
You're going to finance it through your cash flows of retirement.
Yes.
Yep.
So.
Yeah. You actually anticipated. I said before we hit recording, I'm like, I have a scenario for you, but you basically just answered it, so that's okay. Thank you.
Oh, awesome.
So and it's that question of like, when do you? Kind of another version of that question, which is, if I have existing savings, that's earning, X percentage, 4 or 5% right now, but then I, either come into where I have a debt that's significantly higher, do you pull your savings down, and pay off the debt? And then for me, the discipline that comes with that is say, okay, now the money that I would have been servicing that debt with, I need to put back into my savings, because that money just wasn't sitting there. It had a purpose.
That's right.
Even if it was an emotional purpose. And we've talked about this too, that it's like, for me, there's some emotional value for me about having a chunk out there that I just know is there.
That's right.
Right. And
for everybody, I think.
I think everybody enjoys, that, having that out there. So, there's that piece of it as well.
It's balancing the short term with the longer term, right? You could have the emergency reserves, and then you got to be able to have the fulfillment of your long-term goals. Mm-hmm. And then if anything's different, if you have any slush money thereafter, then it's like, okay, how do I allocate?
Right.
What makes the most sense for me? What's most important to me? And, let's make it that at that point in time. And that could change over time too.
And that's why you heard me talk about the flexibility, because that, for my personal finance, that's what I prize most. And so I've generally kept very little debts, not because I think they're evil like Dave Ramsey, but because I don't want the control that they have on my ability to choose.
Yes, absolutely.
But because of the low interest rates, I actually levered up and took out more debt than I've ever had. And I have the money that I could pay it back. I'm doing this arbitrage. But each month I don't pay it off. That money that could pay it off is growing, of course. And so I'm getting more and more choices. It might be, in the end, I just pay them off.
Right.
But it might be that my life has changed, so I don't, because now I can do something else.
Mm-hmm.
And I prize the flexibility above all else. And so
Yeah.
that's why I did it for me.
Yeah.
So.
Yeah. And I would say I'm in the same boat. Everyone else, people have different values and around
That's
that kind
right.
of stuff. For me, that's a conversation that's important to me. It's one that, my new wife and I have been kind of putting our financial lives together and what our goals are. And thankfully we're very similar, which is nice.
I'm glad you said it like that too. As new wife and not current wife.
Yes, new wife.
Congratulations, by the way.
Yes,
You're looking,
congrats.
I was going to mention, you look like you had a little bit of sun on you. And,
I did.
You
I
guys
did.
kind of enjoyed some time on the coast.
I did. Yeah, I went to South Carolina and all that kind of stuff. And I actually had a nice moment 2 days ago. I was walking around near our neighborhood. We have a reservoir. I was walking around the reservoir, and I was thinking, oh, it's all done. Like this summer we bought a house and we remodeled the house, and we then we got married and went on combined 2 families and got the kids in school, and then we went got married and had a vacation and all that. And on one hand, I'm really proud that we took out a mortgage, obviously, so that is new debt, but everything else we were able to take care of and cover with our existing assets and everything. And I had this moment like, I don't have to write any more big checks for a while. Knock on whatever you need to knock on. Now that I'm a homeowner, you gotta be careful when you say that, but but it's nice. But a lot of that was because of kind of previous financial choices and being willing to save and that kind of stuff.
Put yourself in good position. So investment 101. Step 1 is interest rates, realistically speaking, and understanding that and understanding how that can affect you positively and negatively based off of debt or based off of savings, right? And that's for really basic starting point.
And understanding that inflation eats away your spending power.
Yep.
And it's just the same as a negative return every single year.
Yeah.
They have the long saying that $1 today is worth more than $1 tomorrow.
Yes.
Invested. But not invested, then it's worth less than $1 tomorrow.
Yeah. So I think for me, I think the interest rate thing, I think we get, once you kind of get into the financial world, you kind of are forced to learn about that to some degree.
Yeah.
You can only put your head in the sand too much. And anybody who's ever, struggled, got themselves in too deep with especially like credit cards and unsecured debt and the crazy interest rates that comes with that, just, you figure out pretty quickly like what a trap that can become and all that kind of stuff. I think the thing I never really appreciated as much, though, honestly, until I started hanging out with you, Roy, was the idea of inflation. Like, I don't know why, but maybe I'm finally at an age that I can remember when the McDonald's value meal was $3 and now it's $7, and you're just like, oh yeah, that's I'm now, I have a long enough time span that I've actually seen over the long run what happens.
Yep.
To the point that my kids get mad at me every time we go through the drive-through, because I'm like, this used to cost $20 and now it costs $60 to get us all freaking cheeseburgers, blah blah blah.
Right.
They're like, shut up, old man. But it's true. It's true that, and I like that idea that $1 today is worth more than $1
when you specifically talk about buying power. Yeah.
So factoring that into your thought, it's not just about using your inflation to grow, but you need some amount of growth in your investments just to keep even.
Yeah. So that's specifically getting past the emergency fund, emergency reserve bucket.
Mm-hmm.
You have to be thinking about that.
Yeah.
Right. What do I do with this to get something on it? Because it's just eroding otherwise.
Right.
Banks are paying hardly anything still today, right, for a savings account, unless you push them to try and get into some high yield thing.
Right. Yeah.
They're not going to volunteer you a higher rate, but yet they're using your money and charging people 6-7% for mortgages.
That's right.
Yeah.
Right. They're getting a heck of a good spread right now.
Yeah. Yeah. So I think some basic literacy around interest rates, which was covered in that quiz. I appreciate it. This basic idea that inflation, that it's, hopefully again, it's only going up. You know, I mean, like we talked about the stock market, hopefully, at the long term it's going up, but on the long term inflation's going up too. Right. They're chasing each other.
And on that vein with inflation, right? We've had some pretty good inflation the last couple of years, right? And the worst disease on our money is inflation.
Yes.
Yeah.
Right. And if we do not kill inflation, then it doesn't really matter on anything else. Our dollar, our money, our investments, right? It's all kind of moot. Mm-hmm. So we have to really make sure that inflation is under control. And maybe Julian disagrees with that, but he's the CFA and he, talks about things at a really high level.
Yeah.
Yeah, exactly.
You can nitpick what I just said there probably on the 10th degree, but
I probably could. It's probably not for this particular podcast,
but basic understanding.
But a great segue, because when we invest on the institutional side, or RAs, financial advisors in some cases, we are first analyzing that in what we would call a real return, your return less inflation, because that's the only return you actually get.
Right.
And so that's how we're going to always look at things first. We're usually presenting them nominally, but which means with inflation. But you have to look at it from that, and we do, because you can't control inflation.
Right.
It's a market force. So you got to first see what real returns can be achieved, and are they worth it? And so that's why for a long time, before the pandemic, bond investors kept going to riskier and riskier bonds because there was just no return. You were literally losing money, guaranteed to lose against inflation.
Right.
In some cases. So they said, well, let me take stock-like risk with my bond, but it's a bond, so I feel like it's less risky, so that I can get some kind of interest return.
Right.
And
how'd that work out?
Well, it depends. Just like we were talking about in the personal finance side, everything's a trade.
Right.
And it all depends on your situation and the choices you make and when you make them.
Yeah. So interest rates obviously key. The idea that the reality of inflation, that it is inescapable, but it does need to be factored in. What you're doing. Is there any other kind of key basic investing,
sure,
101 that you think that everybody needs to have at least some kind of handle on?
I think there's a couple. So the first is, what are you investing in? Because a bond versus a bond fund are two very different things. Mm-hmm. And then often a mutual fund versus an ETF, an exchange traded fund, are also very different things, and certainly different than an individual stock. Mm-hmm. And then within stocks, big companies versus small versus unlisted or penny stocks, again, so exchange listed versus not, very different things. So first is just understanding what instrument you're using to invest in. So with an ETF, as an example, this is slowly changing, but they are typically rules-based or index-based. So they don't really have a portfolio manager. They have a set of rules that decides what do they buy, when and how, when do they change it, and how do they decide. Why I said that with a caveat is now there are some mutual funds converting to that structure type. Okay. So they're active and managed like a mutual fund.
So with like an ETF, there's basically an algorithm back there.
That's right.
That is, that is
some process.
There's some process. It could be, to give you some examples, it could say, I want to directly replicate the S&P 500. So whatever the committee that decides who the 503 stocks are, that's what that buys. And if they change it, it changes it. Okay. So that could be one. Another could say, to be in my ETF, you have to have paid a dividend for 20 years, and if you haven't, you can't be on it. Or we don't care how long you've paid the dividend, but it must be this much higher than the market for you to be included here. Or you must be this kind of growth company.
Okay.
All kinds of millions of rules like that. But something is setting the tone of how was it constructed. Mm-hmm. And
think of it like a filtering process.
Right. Mm-hmm. That makes sense.
First filter, second filter.
And a mutual fund has a filtering process like that. But in the end, it's people deciding. I'll give you a story. It was an energy company. The analyst was friends with the CEO. through the years. So he was golfing with him. And the CEO looked very inflamed in the face and kind of bloated and very much signs of stress. But while golfing, he was saying, this merger is going great. The merger is going to be great. It's going to be super attributable to the bottom line, blah, 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 blah. Analyst came back, called up the portfolio manager, said, we need to sell that immediately. This merger is about to blow up. Because he was saying everything was fine.
Right.
Like he had said publicly, because he can't give him any inside information. But everything about his body was, this is blowing up.
Danger.
Yeah, so they sold. And that's why people do it in that case, because they can gain an investing edge through all of the research that they do, all the tools that they have, and things like those meetings. Right. So then a person is deciding in those cases.
That human instinct piece of it, right?
Right. Mm-hmm. I remember, when the first news started kicking out about large language models and all that stuff that was going on, and that they were, and like, this is an interesting new use of, basically they're using video card chips. They're using, that's how you power that stuff, because the kind of math that video cards do is what you power that with. And I was just like, man, NVIDIA's going to do great.
Yeah.
And,
that was my thought too.
And there was a handful of people who kind of figured that out, and, they've been a little up and down lately, but I mean, of course, I didn't do anything about it.
They have more millionaire employees, I think, than any other company out there.
Yeah. And I was just like, but no algorithm, is going to be able to put that necessarily, together. So I can see the human side of it.
Yeah. That's the human side for sure.
Yeah.
And the algorithm, by using insight like that, could be, and I'll relate it first to a story that, at our old firm, an advisor had relayed. He had this client, this was in the 80s, they owned Walmart, didn't know what it was, and they're like, I think we need to sell it. It hasn't done well these last 2 or 3 months. So first, of course, her time horizon is wrong in that case.
2 or 3 months, yeah.
Yeah.
Which 2 or 3 months of the retailer was it,
Right, exactly.
April through June.
Yeah. And he said, well, since you don't know, how about before we sell, you find your local Walmart and drive there. And if you can find a parking space, go ahead and walk on in. Just walk a circle around the store, come out, and tell me what you decide. So she calls him up and it's like, wow, I could barely find a space. And he's like, well, how was it when you went in? He's like, it was packed. There was lines everywhere. And he's like, so do you think they're making money? And she's like, I think they're making money hand over fist. So you want to sell it? No. Right? Just a little bit of insight. But today, hedge funds will do that with geofencing your phones. Mm-hmm. How busy is the parking lot? Looks like Black Friday is going to be like this. What's the web traffic? Looks like Black Friday is this or whatever else. So same idea,
right? But
now technologically, and some of those do feed into algorithms, and they're not doing anything because they've just run the data science to know if it's this many cars or they stay that long or whatever it is that they've decided matters.
Right. So that instrument, there's a difference between the instrument of like a mutual fund or an EFT, even though on this ostensibly they feel like this a similar ETF, because similar they feel like a similar thing. I mean, they're aggregating different stocks together, so you're not having exposure just to a single stock, but to multiple. But the way they go about the aggregate, bringing that group together is different. And it may be an important difference. It may not.
There is one big difference that's important for a lot of investors. An ETF is generally, and the rules are slowly changing on this, but they're transparent. You can see all of their holdings at any given time. A mutual fund you can see quarterly. So, they can do what's called window dressing, meaning at the end of the quarter, buy the stocks they think you want to see inside of there, sell them right afterwards, and go back to what they were doing.
I did not know that.
Yeah, it's a form of greenwashing and things, very common. ETF, you always know.
Okay.
Then the second is the ETF trades during the day. So, whereas a mutual fund trades overnight. So if some big event was happening, you have the ability right then and there to go liquid fully. That's not necessarily a good thing with an ETF. It's not necessarily a good thing, but it is a greater option. And then the final thing is that they generally do not cause capital gains, whereas mutual funds almost always do eventually.
Oh, okay.
So, meaning it's just a little bit more tax efficient.
Yeah.
Tax efficient. Okay.
And I should say they cause them when you sell, but not just because you hold them. Mutual funds give you capital gains just by holding them sometimes.
Oh, okay. Gotcha.
Yeah, so when you have that money manager, that mutual fund trading all year long, and it creates some taxation, even though you personally took no money, you get a tax bill.
Mm-hmm.
Right.
Whereas with an ETF, the system and process can occur, but until you personally sell, that's not 100% of the time, but until you personally sell, you don't have to realize that gain or loss. Is a big difference. Just like if you own that Pepsi we referenced earlier and you had a gain in Pepsi and you sold it, you harvested a gain, right? But you didn't pay until you actually sold it.
Yeah.
So okay, that makes sense. And I think one of the things here for us, is kind of the basic level investors is that there are these different instruments and they are understandable.
They are very much.
I think, and at least on a basic level, so and there's some value in knowing, the pros and cons and what you're doing and what you're invested in and how those investments are out there working for you.
Yeah, go ahead.
It's worth adding that these different constructions that these ETFs are using usually relate to some investment theory that's published. So if you could understand down the rabbit hole if you wanted to, why do they construct it this way? Because all of how they construct it, that's all public. You can go read about it. What's the index and why? Where do they select from and how do they select? And so like the dividend example I gave where they had paid for over 20 years, we call those dividend aristocrats. There's research on that. There's dogs of the Dow, which are the ones that did the worst the year before. But there's research usually on a lot of those constructions, and you can learn why.
Nice.
A really cool example. This might help some people that are more visual in their thinking. So owning an individual stock like Pepsi is like being in an elevator with one cable. Whereas if you own an ETF or a mutual fund, you now have an elevator with hundreds of cables connected to it.
Mm-hmm.
So the chance of death is much less.
Right.
A mutual fund basically would be like, think of it as like the bellman's on the elevator with them, right? Making decisions on when and where to stop versus the ETF is just driven by the rules that are set up originally with the actual product.
That makes sense.
Yeah.
All right. Well, I feel like there's like probably 16 parts of this if we wanted to do 16 different episodes.
We probably will eventually have more.
Yeah. So I think, but I think that idea of making sure you take the opportunity, especially if you're working with a financial planner who will take the time, and if you're working with a good one, they will, to explain, what it is that's going on and the mechanics of the different investment options and tools out there, I think is important. I think, and then just making sure that you are cognizant of, things like, that inflation is a pressure, that it continues to exist on your money. And, I love it when I log into my, my retirement account through the church. And it's like, when you retire, you're going to have, X number of dollars or, whatever. This year's your monthly, whatever. And I'm like, oh, that looks great. But then I'm like, wait a minute, that's 20 some years from now. And 20 years ago, how much was a hamburger and how much is a hamburger now? And like I've heard it called the Big Mac, the Big Mac index. Like, how much was a Big Mac 20 years ago? How much is a Big Mac now? How much is a Big Mac going to cost in 20 years from now?
Right.
And I'm like, and it's still not a bad number, but it's not as much as it looks like.
Good reminder to buy assets and not stuff.
Yes. Yeah. So, I think that's a good one. And then, of course, the cognizant of interest rates and how they're both benefiting you and, lifting you up, and then also might be, through, different debts, how that might be, dragging your financials down.
And I'd say another thing to add to that for sure, and the getting started is, we've talked a little bit about goals, and things. So the loans for the mortgage, like you were saying, and retirement and whatnot, is to remember that investing is first a relative game. So if you're investing, as an example, only in tech companies, then you probably shouldn't compare yourself to what did the world index do, because you constrained yourself to this tiny little space.
Oh, okay.
So then what did that space do? But also, even that is somewhat irrelevant. It is, what do you need to do for your goal?
Right.
And so let's say that you needed inflation plus 1% for your goal. Well, anything above that is risk that's optional to you. You might want to take, and that's fine. But that's the first benchmark you should really compare to.
Oh, okay.
So, and that works both ways. I have some clients who think, should I really invest in the market? Maybe I can just do CDs. And I say, well, if you hit CDs, then for your whole investment career, are you willing to live on like $400 or $500 a month, equivalent to today's money?
Right.
And they're like, well, no. I was like, well, then probably you should invest because that's the only way you're going to grow it to
Right.
the right number.
Right.
Right. So it works in both directions. But, you think, well, I got to get the highest return. So you take all kinds of risk. Your friend did NVIDIA. They did, 300%. So you're going to do all of your money in that one stock. And then the tech bubble happens.
Right.
It's 2008 because you were, Cisco of the tech bubble or something.
Right.
Well, can you afford to lose 90%?
Which, I mean, again, if it's the money I'm saving for, the sports car, then maybe. But if it's the money I'm saving for retirement, not so much.
So it's not just as simple as just investing.
Right.
Right? Because people think they can do it on their own. And this is actually something we're going to do in the future is the behavioral investments, counseling essentially, right?
Yeah.
What is
It's a
our
huge
behavior
part.
around it? But we'll touch on it today because if you do it on your own, when do you get in? When do you get out? What do you do when the market's bad? What do you do when the market's good? What are you thinking? What are you feeling? And when it comes to your investments, your feelings don't matter.
Right.
I can't tell you how many people I've had that they have some investment that I call a pet. Oh, we can't sell this, this and that. It's been in stocks they inherited. It's been gold. It's been Bitcoin. It's been some random stock that they stumbled on and is their first great trade or something. And yeah, it's like, well, if it's your pet, then I'll ignore it. Like, no, look at it. Like, no, because if you won't sell it when you should, it doesn't really matter.
Can't be really part of
It's
the
a
plan.
pet.
right. Which, I mean, but again, we talked about the emotionality of it. If having it there because, that was granddad's company or whatever, then okay.
Yeah, you just reposition it into what the purpose and meaning of it is.
Yeah.
Right.
Yeah.
Which is important to us. But anyway, so knowing that can you do this on your own? Yeah. Should you? Probably not.
No.
But that's why we exist, because I'm able to be the buffer between you and your emotions.
Right.
And the info. Because, if you're trying to read on your own, then if you went probably one of the better spots, even though there's lots of misinformation there, but it would be Twitter, because a lot of finance people are on Twitter talking to each other about it, trying to impress each other, basically.
I think you mean X.
X, excuse me.
Oh,
yes.
yeah. Come on now.
But depending on who you followed and this and that, you're going to think that your investment should be completely tied with what the Fed does. Because as an institutional investor, they very much care about that, but it affects them very different than you.
Right.
As a retail investor.
As a retail investor. And so learning to filter out that noise matters a lot. And learning and a lot of the tricks that institutional investors will use that you can use never gets talked about. So a couple of examples. Most people buy their investment on one day, and Wall Street never does. They, if you think like a bell curve, they say this looks like a good investment to me, so they start their position, and just to again make up some numbers, maybe they know their position will be 5% if their thesis starts to play out. So today they buy maybe 0.5%. We'll dip our toe in and see, is the thesis beginning? Oh, it's starting to. Let's get 2% now. Let's get another 1.5. Let's finish it out. And then as it's playing out, but it grows above 5, well, our target for this from the risk perspective is 5. So we're going to start trimming it. We're not selling the position. We're trimming a little.
Right.
And the difference in timing of that is enormous. So I once had a client who made big stock trades, 150,000, 200,000 stock trades at a time. And we went into a riskier than normal for her stock. And it was when I was at the same time doing with my mom. And so she kind of went against advice, bought it all at once. And I started the position for my mom. 2 weeks later, the company came out and said, we're going to miss earnings by a lot, and we don't know why. And so immediately the stock was down 50%. And the client is, oh, should I sell? Should I, gosh, I've lost $100,000 in 2 weeks, blah, 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 blah. And it's like, well, look, it's still a good company like we thought. All the reasons we bought it still exist. This is something to watch closely, and it might be an opportunity. For my mom, we bought in largely in that because I was already convicted on it. And she held, but didn't buy more. They, I think it was 6 weeks later, announced a private equity firm that's well-respected was going to be coming and joining their board to help them and this big turnaround plan. And we reached the valuation targets about 2 years later. The difference in return was the client made something like 35% of which 12% was the dividends. And my mom was somewhere like 58%. I'm talking annualized returns.
Right.
And it was because we capitalized on the 50% loss.
Right.
And
Yep.
and so that's why Wall Street does it, to protect them in and out. And then you're not timing the market, because even Wall Street, with all of their advantages and all of their money and all their connections, they must be right 79% of the time to take advantage of timing. And the average fund manager is right 63 on timing.
Yep.
So even they can't do it with all their advantage. So retail investors really should not do that.
Right.
And by bell curving in and out, you never do.
Yep.
I like
So I know we're out of time, but I know there's lots more that we could probably talk about
absolutely.
and ask questions. But the big thing is, if people have questions around any of this stuff specifically, let us know, because we can make more content specifically to
Love
it,
to do it.
talk
Yeah, lots.
specifics, all that good stuff. So
and always like, whoever you're working with, whether you're working with Roy or Julian, or whether whoever you're working with your financial planner, having one is a great thing to have. And two, ask questions. And if you're curious about how something works, if you're working with somebody who is worth their salt, they should be interested and excited to take the time and explain to you. I love when people ask me how things work and I get to explain it to them. Like, this is great.
Yeah.
you like it when people ask you how God works?
Well, it depends on
How's
what
the meaning
exactly
of
I
life
ask you,
work
but
exactly?
yeah. We deal with only little things around here. But we do. And hopefully, if you're working with somebody who knows what they're doing and has your best interest at heart, they're going to want you to be an educated client and consumer. So.
And I got one last thing to add there. A good way to check that of how much they pay attention is, in our industry, we have something called style boxes. So that's where we divide the universe of products and stocks by their size. We call it market cap.
Mm-hmm.
And by their type of stock. So think value, aka cheap stock, growth, which is a fast growing stock but maybe expensive, and then kind of in the middle we call core or blend. It's not uncommon to see advisors that aren't paying attention to this have 4 or 5 holdings per style box. So large cap value. Here's 5 different positions. Those become the index when you have that many, if they're active funds, and just cost a lot more. And so that's a good way to start to gauge. And like you said, ask questions.
Right.
So.
Well, I appreciate you.
Yeah.
Well, as always, I always learn a ton doing this, and I really appreciate it, and I hope people do. You can find our previous episodes, some of which we've referenced in here, especially that What is Financial Planning episode, I think is a good companion with this one, on theaboutpodcast.com, wherever you get your podcasts. Most everything is up on our YouTube channel now, and some of the early stuff doesn't have, our smiling faces as video necessarily, but all the new ones do. We've been improving our setup and our technology and everything. So hopefully everybody's noticed too a little increase in the quality of the audio and the video along the way too. Though we've been pretty good from the beginning. We've done all right. So you can check us out there, like and subscribe, and of course, if something has been interesting to you, share it on the social medias. People really appreciate that, and we love it when people find us and get a hold of us. And if you, again, like Roy said, if you got questions, let us know through the website or comment on Facebook or comment on YouTube. We do read those. Anything like that is a good way to get a question to us, and we'd love to know what you're thinking about and how we can answer it.
Yes. Thanks, everybody. Really appreciate it.
All right. Thank you again, Julian. Appreciate you coming in.
Always a pleasure.
It is. All right. And have a great day, everybody.
CWA is a Securities and Exchange Registered Investment Advisor. No content contained herein should be construed as an offer for investment advice or an offer for the purchase or sale of any security, insurance, or other investment product. Investments involve the risk of low loss, including loss of principal. Please consult with a qualified financial, tax, or legal professional before implementing any strategy presented here. Data presented here are obtained from believed reliable sources but cannot be guaranteed as to completeness or accuracy. CWA is a Securities and Exchange Registered Investment Advisor. No content contained herein should be construed as an offer for investment advice or an offer for the purchase or sale of any security, insurance, or other investment product. Investments involve the risk of low loss, including loss of principal. Please consult with a qualified financial, tax, or legal professional before implementing any strategy presented here. Data presented here are obtained from believed reliable sources but cannot be guaranteed as to completeness or accuracy.